Trillions of dollars are sitting in cash. Treasury yields are at record levels. AI is fueling a borrowing boom, and investors are asking one question: where are the opportunities now? BlackRock's Rieder joins us with his latest outlook on the markets and more right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining me today. Very excited to welcome back to the studio Rieder from BlackRock. By the way, he is also a member of our research advisory board here at UBS, and that is a group of experienced market leaders and industry experts who collaborate with UBS's Chief Investment Office to explore the key themes driving markets, the economy, and long-term investing. And that board's perspectives help broaden the conversation around today's most important investment topics and bring very valuable insights to UBS clients and advisors, and Rick is one of those members. Rick, good to have you back. Great to see you, my friend.
It's been a while.
It has been.
Glad to be here.
And by the way, you're here on a really interesting and auspicious day for the bond markets. As we're sitting here, the 30-year Treasury yield is at 19-year highs. 2007 was the last time we saw these levels of 5.32, 5.32, 5.31. Just before we get started, because this will probably lead us into the rest of our chat, what do you attribute this extreme rise in yields on the long end of the curve?
So, by the way, it'd be better if the equity people get to come in and say it's all-time highs and record highs. I get to the cheapest time in the bond market. So, listen, there are a couple of things that have been happening, and I think there are a bunch of people who put stories to what's happening that I don't think are 100% true. One, I actually think if you think about when the Fed met last, employment has actually been sluggish, inflation has actually moderated. So I don't really think this is, Fed's going to be hiking dynamic at play. I do think there's something that is significant, though, and that is the fact the amount of financing that's coming to the market is pretty impressive. So you've got Treasury issuance, you've got a fiscal dynamic that's quite real, and then you've got this immense amount of AI data center supply that's coming to the market all at once. And by the way, when rates move higher, you get mortgage rate extension. And so all those things have led to just more supply into the market. So I think it's a supply-demand dynamic. We also, historically, you had much greater contribution from other parts of the world that were buying our treasuries: China, Japan, Brazil, other parts of the world. And quite frankly, they're funding their own domestic and or buying gold. And so you don't have the buyer base isn't as extensive. People have pulled back saying, gosh, I'm going to wait a little bit. Treasuries don't do for me what they used to do for me in terms of, gosh, they're a great hedge against equities, particularly if inflation's higher, means equities get hurt at the same time that bonds do. So, listen, I think it's primarily a supply, but I think people have also gotten a sense for, gosh, long end interest rates, how do they fit in my portfolio today? And you don't have the buyer base you had before.
Yeah. It's interesting because, we're obviously talking a lot about artificial intelligence. I want to get into that with you in a little bit on the debt issuance side, because corporate debt, it's really getting fueled a lot by what's going on the AI side. But I want to keep with the rates, because we just, as you mentioned, Warsh had a meeting a couple of weeks ago. He talked about periods of watchful thinking when they talk about, are you going to raise rates? Now, the market thinks they're going to raise rates before the end of the year. CIO here at UBS doesn't think that's going to happen. They expect probably 2 cuts next year. What are your thoughts on that when you tie it into jobs, inflation, all the things that contribute to what the Fed has to think about every time they go into a meeting?
By the way, not a lot of people believe exactly like you described. I think the same.
Yeah.
I think it's crazy. I think hiking rates, when you're looking at, by the way, if you take, I think we brought a chart to show where inflation is going. If you take the 3-month moving average of core CPI, we're running at 1.6%.
Yep.
The 6-month moving average is 2.4. Core goods inflation, which I would argue the interest rate is the most influential on, core goods inflation is running literally at 0. You have service level inflation, but even service level inflation is not running that high. So, you look at this chart and say, gosh, the Fed's going to hike into this? It doesn't make a lot of sense to me. And plus, in the employment world, we've hired, the 3 months, we've hired 20,000 jobs. If you strip out healthcare, it's negative.
Right.
And if you go back 6 months, the same dynamic. Meaning, I don't think the Fed should be hiking, and I agree. I think the next move is going to be a cut. Like you say, markets are anticipating a hike. You have a hawkish committee. I will say one thing about it. I think, get asked all the time, Fed credibility. Listen, I think they need to give the new chairman a chance. I think he's got these task forces. I think he's going to lay out what are those task forces. These are complex issues. Is policy restrictive? I don't know. Housing's having a tough time. AI is going to keep spending. And by the way, what is the most effective tool? Is the interest rate, or is it liquidity? Is it a balance sheet? Is it regulation? So I think he's going to work through a bunch of these issues. The one thing that I think will be critical going forward, and I think Jackson Hole could be an important moment.
Yeah, and that's coming up really soon.
Yeah, and I think that will be at the end of this month. I think that will be, what are the metrics you're looking at? What are the tools you're using to analyze inflation, to analyze these complex subjects? And I think if he can give a little bit more clarity on the metrics, which by the way doesn't mean forward guidance. People are freaked out. We're going to get less forward guidance. I actually think that's a great thing. I think the markets have become too married to, quite frankly, the dot plot or forward guidance that's been wrong. Think about transitory. You think about you think about economic projections. The Fed haven't been right. I don't think we need as much forward guidance. Markets just need, give me the metrics, give me the tools that you're going to utilize to assess the what you're thinking about in terms of inflation, employment. And I think Jackson Hole could be a time to that. And if you got more clarity around it, you could see rates start to stabilize and rate volatility come down, which is also important.
And maybe the markets will start pricing in a cut in 2027. I mean, there's only so much they can anticipate that they're going to hike before the end of the year. And given that also, I mean, there's something like $8 trillion of cash in money markets, right, on the sidelines globally. So people are missing out on this opportunity to look at, I mean, if you want duration, I mean, you've got it, 5.3% on a 30-year Treasury or 20 years, just like, I think, like 1 basis point below that. Even the German Bund is at high levels since we haven't seen since 2011. So where would you be putting some of that money to work?
So I think today, I still think we'd be a bit careful about long-end interest rates. And I think, we've kept our interest rate exposure to a pretty nominal level. Income really works. So I think when you go back and you say, I think 2 years from now, 3 years from now, people are going to say, wow, I got to buy assets. Like we run an ETF called BINC. We're running close to 7% yield in the portfolio with less than 3 years of interest rate exposure and an A- rating. I've spent most of my career longing to do something like that, creating income. You don't have to take as much interest rate exposure. I think to me, that's what you got to do. And by the way, Europe is super, to your point about bonds, Europe is super attractive. I mean, think about, we had years of negative interest rates. Now, as a dollar investor, you get the cross-currency benefit. I hold the largest percentage of European fixed income that I've ever owned. And by the way, emerging markets, or if you don't think the dollar's going to appreciate significantly, which I think is a fair assessment, EM makes some sense. So, my view today, diversify fixed income. Equities are different. Focus, concentrate, AI. These stocks are going to continue to do well. In fixed income, I'm trying to be as boring as humanly possible and diversifying. Just keep the thing stable with a lot of yield so people can sleep at night.
It's funny, most of the time in most of my career, maybe yours, fixed income was kind of a boring asset class. It was staple and stable, and it's actually really exciting these days given everything that's going on. And that sort of takes us to the AI side of the story. It almost feels like the bond market, especially on the corporate bond side, is having a little bit of a renaissance because there's so much potential debt that's being issued from a lot of these AI companies on the corporate bond side. It's giving investors a real opportunity to kind of get in here. Do you think that that's where we should be thinking about as far as like long-term planning?
So I've historically always been a believer in technology. You should own it in equity.
Yeah.
Like bonds, we should be a little more safe, and utilities, telecom bonds, et cetera, industrials. Today, I think you have to reassess your model a little bit and say, gosh, maybe I will finance some of these companies. Some of the data center financing that's coming, that's 2, 3, 4-year debt, that's getting you some really nice yields. Would I pick away at some of that? For sure. Some of that, some of the hyperscaler issuance out the curve, the yields are pretty high today. That being said, I don't think there's any race because they're going to keep coming to the market. So I think today, I still think AI, equities, technology equities, I think your upside is tremendous. Would I start picking away at particularly some of the shorter dated AI data center debt? I think so. And then, listen, I think to own part of your portfolio in some of the hyperscalers, maybe a bit of it. I just don't find like we got to race into long duration technology debt. I just don't think there's an emergency that we get in there. There's plenty of ways to get yield in the portfolio, and I'd be a little bit more careful today on that side.
Is there a risk that spreads need to kind of adjust a little more widely at this point?
Listen, I think there's a lot of, quite frankly, I've seen industrial, I don't know how many different cycles.
Yeah.
And you see industrial development, you see like the telecom issuance that was sizable. This is really big. This is really big. And I think part of whether you talk to people in administration or otherwise, like, why are these rates doing this? Like, we got to reprice real rates to the point where we're going to finance a lot of it. And there's something it's not just the amount, and there's something that's really different. The IRRs, the returns on their investments, that 25, 50 basis points doesn't really make a hill of beans of their weighted average cost of capital. So as long as their IRRs are so high, they can issue at cheaper levels. And so on the, from the bond side or the investor side, you say, okay, maybe I'll be a little bit careful about it, because it's not only going to come, but it's going to come at levels that they just need size.
Right.
And they're willing to price into that size.
And potentially everybody wins in that scenario.
Correct.
Yeah.
Correct. You just, as an investor, you just got to wait for the deals that make a lot of sense, that have already priced in. Like, wow, that's a lot of yield. I've already factored in the supply that's going to keep coming.
What do you think about the intermediate part of the curve right now, that, 2s, 5s, especially the 5-year? We like it here. I mean, the CIO really likes that 5-year. It's about 4.39 right now, which is an unbelievably good yield for a 5-year. What are your thoughts on that, given, 5 years intermediate, that belly is, it's not much of a belly now, but.
Yeah, I hate to be that agreeable, but listen, that's my favorite part of the curve.
Yeah.
And by the way, the very front, it carries well in a portfolio. The very front, it's pretty hard to fight now where you're pricing the Fed, given you got a hawkish committee. But the belly, if you think about where forwards are going to go, and you can actually get some real price return, if they do flip, which I think they will, to an easing posture, you can actually make some money in the belly of the curve. Not only do I like the belly, I like owning the belly of the curve and then owning some yielding assets spread to that.
Sure.
And that, to me, by the way, you run your break-evens of owning that, you'd need rates, literally, if you're owning spread assets, if you assume default cycle is reasonably low, which I think is right, away from some parts of the loan market, boy, your break even, you'd need rates to go up 75, 80, 85 basis points to be down on those trades. I don't think we're going there. So the break even relative to cash of in that belly is pretty attractive today.
And in a well-diversified portfolio of equities, some alts, got some little bit of commodities in there, and the fixed income.
Yeah.
Great way to think about it, especially right now in this market. I can't let you go, because the one time I did have you in the studio and I forgot to ask you a question about what your latest and greatest technological sort of aficionado brain is thinking of. I'm going to ask you, what's the latest and greatest tech that you're geeking out on these days?
So first of all, like things like robotics, I need to have my own robot.
In the house.
Yes, I do. Although I got to figure out the one that's not, fully, they're listening and everything in my life. But anyway, I got to figure that. I got to figure that one out.
Right.
By the way, I'll say the two things that are really cool. First of all, full self-driving, and this is part of why I'm a little wigged out about employment in this country, et cetera. The full self-driving cars are crazy now.
Yeah.
Like, you literally don't even have to pay attention. Like, they are literally, I'm not advising that. But anyway, they're pretty incredible in terms of, that blows me away now. And then the one that I think that I'm getting into now, I don't think the technology's there yet, but I think we're not more than a few months away, is I think the glasses. And I know Meta's talked about it, Google's talked about it, Apple has gone down the road, and I think maybe stopped and started around. But boy, I think when you think about what mobile telephony is, and the adjacency around glasses and things that can happen around glasses, some of it's virtual reality that's pretty extraordinary around it. Somebody told me the story. You could, at some point, we're going to be sitting at dinner, and you'll have people sitting at the table that actually won't be there because you'll see them on your glasses, which I've said I don't think the restaurant's going to love that, but only one person's eating. But anyway, I think glasses is going to be, optics generally, optical generally, I think is going to be a pretty powerful dynamic.
It's funny, my producer Kyle was in my ear saying, it's almost like every time you watch a Black Mirror episode, you can almost anticipate that we'll see that device in our own lives in the next 10 or 20 years, maybe less.
Totally.
It's exponentially
upgrading.
upgrading.
That's what makes it so cool today.
Yeah.
And you can invest around some of these.
Exactly. We love the AI investing here, our transformational opportunities.
Very cool.
Great stuff. Rick, always a pleasure.
Thanks
I feel like I
for
could
having
talk to you forever. So thanks for coming by.
Thanks for having me. I appreciate it.
Great to see you. Rick Rieder from BlackRock. Thank you all for joining us. There's a lot more information coming out of Rick and BlackRock and the rest of our great partners at ubs.com/views, including content from our own Chief Investment Office here at UBS. Plus, you can follow UBS Trending on social media. We're on Instagram at our dedicated channel at UBS Trending. You can find it right there on your screen. You can also check us out as far as UBS goes on LinkedIn and Facebook. So lots of content there for you. And as always, if you have any questions about what Rick and I spoke about today, please make sure you continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.